Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about earnings per share. We've talked about why they're important, what FASB requires, and about the two different categories of EPS that we have to record, basic and diluted. We then moved on, after calculating all those EPS numbers, to how we account for the dilutive securities that are part of that EPS calculation. Diluted EPS calculation, I should clarify. Now we're going to talk about the other dilutive security, and that is warrants. You'll notice here on the slide that we're focused primarily on employee stock options. You should know that there are two types of stock options. There's the kind we sell, and there's the type we give to our employees. The ones we sell are a way to make additional money. We sell the options on the open market, and we hope we'll get the money from selling the options, and then later, as they exercise the options, it will give us the funding that we need to grow the business. Those are commonly done, but they're not as common as equity options. Equity options meaning that we give our employees the ability to buy shares of stock. The logic behind these stock options is to get them to buy ownership in the company. We want them to be owners so that they're vested in the company's progress and its growth and its development, so they're more engaged. We also use it as a way to provide additional compensation. And you see a lot of startups, Silicon Valley type companies that offer a lot of stock options as a way to attract really good help, especially when they don't have a lot of cash right up front in their business. The nice thing for us is that the journal entries for stock options are the same, no matter what the reason is for giving them to our employees. The journal entries are a little bit different for options that we sell. But again, we've got to cut down somewhere. We can't have all the fun in this one class. So we're going to focus on employee stock options in intermediate accounting and leave other stock options with the other warrants for an advanced accounting class. Now, once we decide to issue the options for whichever of the two reasons we just mentioned or some combination of the two, the next thing we have to decide as a company is whether these are equity options or liability options. An equity option is designed primarily for that first reason. I want them to be owners in my company. So the only thing I will allow them to do with the option is to bring them in and buy a certain number of shares at a certain price. That's it. The hope is they'll then keep those shares and again, as owners, be more engaged in the company. But that's not what a lot of people do. They're going to exercise an option and then turn around and sell it on the open market and make some profit right now. That's where the additional compensation piece comes in. So I get a stock option from my company, lets me buy the share at $15 a pop. I see that the stock price is $20 a piece on the open market, so I go buy it for $15 and I sell it for $20. With an equity option, that's what I have to do as an employee. I have to come up with the money to buy the shares at $15 a share, and then I can make that $5 profit by selling them on the market. A liability option doesn't require the employee to do that. Under a liability option, as more of this additional compensation perk, I tell them, you have a choice. You can come back and buy the shares for $15 a share and keep them. Or if you're just going to sell them anyway, I'll just give you the $5 a share that you would make on the open market. That's a liability option. It gives me the possibility as the employee of either getting the shares or getting the benefit of the share. And I can get the benefit of the share as stock, or most commonly, I get it as cash. I get that $5 in cash and I'm ready to go. Alternatively, they could give me shares of stock. They could say, you know, instead of us selling you 10,000 shares at $15 a piece and then you go sell them, why don't we just give you, 10,000 shares times $5? We can give you this many shares of common stock for the money that you would make on the market. So those are our options there with options. I know that's an awkward way to say that, but that's what we're looking at with our stock options, is deciding, is this equity one possibility just to get you to buy stock, or is it a liability option where I give you a choice, options, or I'll give you the difference somehow. What I decide as far as equity versus liability changes how I do my journal entries. Now, both options get recorded at fair or market value, not intrinsic value. Now, fair value is what the options would sell for in the market. So if I were to take my options and I don't want to wait until they vest, I'm just going to take them and go, I could take the options, sell them to other people, and turn them into that other style of option that's just being sold on the open market. We can also use what we call the Black-Scholes model to figure out what the market price would be if it was being sold on the market. And we're not going to get into Black-Scholes, and we're not going to get into how the stock market decides what those market values are. That's more of a finance question. but we take that number from finance and we use it as the value of the options. If it's an equity option, I take that fair value and I divvy it up over the years the employee has to work to earn it. So if you grant me the options and say at the end of 3 years, if you're still working here, I will give you these options. It's a bonus for today, but you'll get it in 3 years if you keep working for me. You would take the fair value of the options based on this Black-Scholes model or the market value, what they're selling for on the market today, and you would divvy it up over the 3 years that I'm going to work for you. And you'd record some kind of compensation expense, wages expense, salaries expense, etc., for the 3 years. If it's a liability option, we do it a little bit differently. Instead of coming up with one amount and divvying up over 3 years, we keep track of the change in the fair value every year. So my options that you granted me are worth $10,000 now, so you'll record $10,000 in an expense. Now, in a year, the value's dropped to only $8,000, so you record a reduction to compensation expense for that $2,000. The next year, it's gone up again. Now they're worth $15,000, so you record from 8 to 15 as compensation expense, and you keep the liability at the fair value. And whatever you need as your journal entry to get to fair value, that's the expense for the period. It can be debit or a credit to the expense as you change that liability. What we don't record is intrinsic value. Intrinsic value is the difference between strike price and market value. So in our earlier example, the intrinsic value would be the $5. I don't use that. I use the market value of the option itself, not the value I think I can get from selling the stock later. Now, we've already talked through the basic process here, but just to review it briefly before we jump into an example, remember that we're going to calculate total compensation expense as the number of options times the fair value of each option. Again, fair value coming from either the open market, if the options are being sold on the open market, or from this Black-Scholes or a similar finance model. We divide it by the number of years in the service period. That's the amount of time I have to work to earn them. And I record a compensation expense each period into additional paid-in capital stock options outstanding. So debit compensation expense, credit this additional paid-in capital account. And finally, at the end, we record what happens to the option. I can use them. That's what we call exercise. It's the only kind of exercise I'm involved in. The loss of those options, meaning I quit before my service period ends and I never earn them, or if they expire. So you grant me these options, I earn them in 3 years, I've got 2 years to use them. If I don't ever come up with the money to buy them at 10 bucks a share within those 2 years, I lose them because I couldn't get the cash. So we've got 3 possibilities. Let's take a look at an example that walks us through all of these steps, including those final entries. This is Alice, who works for Fountain Incorporated. She's received 1,000 stock options of Fountain's $3 par value common stock. They can only be used to purchase common stock. Whoop, stop right there. That makes them equity options. They can only be used to buy stock. That's it. So they're equity. Second, on the day of the grant, the market price was $8 a share, and they set that as the strike price for the options. So eventually, Alice is going to pay $8 a share for these 1,000 options. Alice must work for 4 years before she can exercise the options, and the options expire 5 years from the day we grant it. So looking at a timeline, we've got a 5-year window. We're starting here in January 1. Alice will work for 4 years to earn it, and then we have 1 year where she can actually try to make the money by buying it for $8 and selling it for whatever the market value is. The fair value of the options on 1/1 of year 1 is $6 per option. And again, one option is to go to the open market. More commonly, again, we use that Black-Scholes model and we get that value. We want to do all of the necessary journal entries. If she exercises the options on March 14th of year 5, if she quits on January 1, year 4 and loses the options, if she misses the deadline in year 5 and just doesn't get a chance to get the money. Let's start with step 1, obviously, which is to calculate the total compensation expense, also known as the total fair value of the options. To do that, we take the total number of options times the fair value per option. And in this case, she was granted 1,000 options. Fair value on the day they were granted is $6. So my fair value of these options, or my total compensation expense, is $6,000. That's our best bet on what she will actually be able to earn using these options. Step 2. Next, we're going to get the compensation expense per year. And to do that, I take my total compensation expense and I divide by the number of service years. So for Alice, the total compensation expense is this $6,000. And from our cool little graph, we know that it'll be 4 years before she earns them. So $1,500 per year. That's what she's earning each year. Step 3 is to record compensation expense each year. And the nice thing about equity options is it's the same journal entry every single time. So I'm just going to make the entry once. I'm going to debit compensation expense of some kind. This could also be salaries expense, wages expense, executive salaries expense, whatever we're using. Additional paid in capital stock options outstanding. This is to record 1/4 of stock option compensation from year 1. It's an adjusting entry. I would make it every year for 4 years. We're going to go ahead and stop here because this is a good break. When we come back, we're going to do 2 important things. First and foremost, I want to make sure that we look at the journal entries when these options are used, lost, or if they expire. The other thing I want to take a few minutes and talk about is the deferred tax consequence of stock options, because there's a difference between IRS rules and GAAP, and we need to make sure we're comfortable with that. So fun stuff coming up, more about deferred taxes, always exciting, and then that last set of journal entries for equity options. We'll see you then. Thanks.